Hi, today we're going to talk about other derivative instruments. So, first one is swap. So, swap is also an OTC agreement. Um, as part of swaps, there's an agreement to exchange a series of cash flow on periodic settlement dates over a certain period of time. So, you can think a swap is a collection of forward agreements where these maturity dates are already predetermined, uh, and it and and swap happens over a certain period of time, so it's already decided for next 2 years we'll be exchanging the payments at every 6 months, so those dates are already decided in advance. There are three popular type of swap. First one is most popular. It's called interest rate swaps and also called plain vanilla swaps. As part of this swaps, these party exchange uh, payments. Uh, and in this arrangement, one party pays a fixed rate interest to other party and other party pays the floating rate interest. Most of the times these payments are netted, so the party who's supposed to make the fixed rate payment, and at the time of payment date if fixed rates are less than the floating rate, then the fixed rate payer will receive the payment from the floating rate payer, so these payments can be netted. The another famous swap is currency swap. As part of this swap, notionals are exchanged at the beginning and at the end of the swap. So notional is kind of a amount on which these interests are calculated. So let's suppose one company is have operation in multiple countries, and they have exposure to other currencies, so they can get into to mitigate that other countries currencies exposure, they can get into swap with some other party or with some other bank of the other country. So as part of these swaps, the payments are exchanged, the notes are exchanged in the beginning, and one party pays the interest rate in one currency, and other party pays the interest rate in other currency, and these payments are netted at settlement dates. Uh, uh, Without going into much detail, we can go to third swap. It's called equity swaps. So in this case, in equity index returns are exchanged with interest payments. The second type of derivative which you're going to talk about, it's called option. So option is a choice but not an obligation for an option buyer to exercise it. So option is a right to buy or sell an asset to the counterparty at a fixed price at the maturity date. If the option can only be exercised at the maturity date, it's a type of a European option, and if it can be exercised at any time before the expiry, it's called American option. So there are two most popular call type of caution option. First one is call option. It's a it's an option or it's a right to buy an asset at a predetermined price. And put option is a right to sell an asset at predetermined price. Exercise price is a predetermined price. The option premium is the cost to buy an option. The third derivative instrument which we're going to talk about is called CDSs, which is called credit default swaps. It's a way to transfer credit risk from one party to another. You can think of it as an insurance contract. So, uh, so the seller protects the buyer for a specific credit loss in exchange of a premium payment. For example, there is a bond issuer and there's a bond holder. So bond issuers, by issuing the bond, they're kind of borrowing the money, and the bond holder, by buying the bond or by holding the bond, they're giving money to the bond issuers. So in this case, they think this bond uh, may default, so they may get into a credit default swaps or CDS swap with some third party, and third party will cover the credit loss or credit event. um, in case of credit event, the third party will make the payment to this party, and this party has to pay the insurance premium or the CDS premium to that third party. So in the case of credit event, the seller, who's like third party, must cover the buyer's loss associated in reference of obligation contract. Thank you.